Evening all. As Alison says, just a quick reminder from a housekeeping perspective that we are recording today. Hope that's all right with you all. Lovely to have you with us. It's obviously everyone's favourite time of year at the moment. We've got the longer days. In theory, we've got the warmer days, although it doesn't look so much like it's warmer from a snow perspective at the moment. But most importantly, of course, we're nearly at the end of the tax year. So this evening, what we're going to do is talk a bit about tax planning and some of the key steps that you can take ahead of time that might help mitigate that tax bill. What that means in particular is using the various reliefs, allowances and exemptions that are available to you. So this session is a bit of an overview. And from my perspective, the best way to really get on top of things is through combining all of that knowledge with bespoke, effective financial planning. And as the slide says, meeting the demands today while planning for tomorrow. Which brings us seamlessly onto who I am and who we are. My name's Ed Evans. I'm an advisor at Stringerman Chartered Financial Planners, and we're a senior partner practice of St James's Place. We're based in Berkhamsted. So for those in the audience that are our clients already, you know who we are, but for those who aren't our clients, what we do is provide bespoke, face-to-face, long-term financial planning and advice, helping our clients essentially figure out a plan and then go out and achieve it. So how do we do that? Well, the main thing is understanding our clients and their lives, their work, their family, their lifestyle, their dreams, their aspirations. It's taking all of the financials, what you have now, what you will have in the future, and then planning to make all of those things align. Building a financial roadmap, if you like, or a financial plan. It's fun, it's fulfilling. It's why I chose to do this job a couple of years ago and leave the rather more data-heavy world of investments. When we do all of this, working with SJP, St James's Place, gives us access to their vast resources and expertise and allows us to focus on what we do best, which is delivering a top quality service to all of our clients. So on to tax. Tax planning, crucial element of financial planning, maybe even the core element of financial planning. I would reinforce that it's critical really to approach things on an individual level because we're all exposed to tax in different ways and have different goals, different aspirations. Some of us might be paying income tax at basic rate at 20%. Others might be at the additional rate at 45%. You know, some of us might have a capital gains tax liability, maybe having sold a buy-to-let, for example. Others might be worried about inheritance tax. In my experience, inheritance tax is the tax that causes the most frustration, shall we say. But whatever the scenario, really important to avoid looking for a silver bullet solution. We've all seen that approach get a number of celebrities, sports personalities and the like into hot water over the years. In my experience, the best approach is to, one, understand your exposure to taxation. Two, understand which reliefs, exemptions and allowances you're entitled to and whether you're using them effectively. And three, only then start looking at some of the more active strategies that are out there to achieve a reduction in your tax liabilities. So as I say, cornerstone of a tax efficient strategy is being aware of those reliefs, exemptions and allowances and to make sure you're using them properly as well. If HMRC offers you an opportunity, it makes sense to take it. They're not known for being charitable. We're going to take a few of those to talk about today. And with some of them, if you don't use them during a given tax year, then you lose the allowance completely. It's why it's so important to get ahead of this and get on top of things early. So starting with individual savings accounts then, or ISAs, they're deservedly popular and you'll see them discussed a fair bit most likely between now and the end of the tax year. They've been around for a while, since 1999, and there are now four main types. You've got cash, stocks and shares, innovative finance, and lifetime ISAs or LISAs. All in, you get an allowance of £20,000 tax year that you can invest into an ISA, and it's one of those use it or lose it allowances as well. There are an awful lot of confusing rules around them and also some potential penalties out there. So it is really important to do thorough research or to get advice. Many of you may already have an ISA. As I say, they're popular things. The real question is, which type have you got? And is that the type that's most aligned with what you're actually trying to achieve? With that in mind, most people will automatically opt for a cash ISA. That's what the research suggests anyway. And if you look at the 2020-21 tax year, cash ISAs accounted for about 66% of all of the ISAs that were subscribed to. So popular things. But is cash always the right place for your ISA savings? Well, holding wealth in cash can be a great decision if it's money that you might need in the short term. The problem comes when cash becomes a long-term investment, which is how many cash ISA holders are treating it. Goes without saying, if the interest on the ISA doesn't keep pace with inflation, your spending power is reducing. So in real terms, you're losing money. If savings rate's 3% and inflation is 5%, your money is falling in real value every year, not rising. And that's an issue if we're making long-term plans. So if you do have a cash ISA, think, have you been keeping cash in it for more than 5 years? Do you know what interest rate you're getting? And are you confident that it's doing what you want it to do for you? Since April 2016, most savers receive their interest gross of tax. So what does that mean for cash ISAs? Well, the personal savings allowance enables basic rate and higher rate taxpayers to earn tax-free annual interest of £1,000 and £500 respectively from ordinary cash accounts like savings accounts, current accounts. That may mean, depending obviously on your circumstances, that the various tax advantages of an ISA wrapper are somewhat redundant when it comes to cash. What that means really is that those advantages might be better used elsewhere. It's still important to have an emergency fund that you can access quickly, which should be in cash, because other investments, of course, can lose value in the short term. But for longer term goals, a stocks and shares ISA is usually a better option, as there's more potential for long-term growth, and so more potential value in the ISA's tax advantages. It's also worth saying that if you have a lot of cash sitting around, with increasing savings rates at the minute, it would be worth reviewing whether or not you might be liable to tax where previously you weren't. Good thing to check out. So, is a stocks and shares ISA a better use of this year's allowance if you're investing for the longer term? Stocks and shares ISA ultimately provides the opportunity to generate both income and growth, free from income tax and free from capital gains tax. Some occasionally that we encounter are put off by the name of a stocks and shares ISA and prefer the perceived safety of a cash ISA. I think quite apart from the slightly quieter risks that are inherent in holding cash, like that inflation risk that we talked about, many also aren't aware that you can have a stocks and shares ISA that actually doesn't have any stocks and shares in it. You could invest in funds that are investing in property, for example, or in gilts or other sorts of bonds, like corporate bonds. Ideally, though, you'd be looking to invest in a balanced, blended portfolio that's tailored both to your attitude to risk, but crucially to what you're trying to achieve, giving you the opportunity to take advantage both of the tax breaks that you're getting in that ISA, but also that income, capital growth, or both. So from my perspective, I'd be suggesting that even for something as simple as using your annual ISA allowance, you should really be thinking about getting professional advice on it. It's a really valuable allowance, and when it's a use it or lose it one as well, it's important to get that right. So that's ISAs. What about the pension side of things? Saving for retirement sounds simple enough as an aspiration, but as you expect, the challenges can be pretty complex. First off, we're all getting older. Over the last 40 years, life expectancy in the UK has been ticking up. We all know the reasons why. We've got advances in healthcare, better living and working conditions, better nutrition, all the rest of it. If you look at 2018 to 2020, and using rounded numbers, life expectancy at birth in the UK was 79 for males and 83 for females. And if you look back only 40 years, it was 71 and 77 respectively. So that's quite a hefty increase within many of our lifetimes. Unfortunately for the state, our living longer means a greater and greater burden on the nation's coffers. It also means, of course, that our pensions are going to have to work harder for longer. The cost of tax relief to the Exchequer has triggered some pretty substantial reductions in the various available allowances and reliefs associated with pension planning. So we can see one there with the annual allowance. In about 10 years, the annual allowance has fallen from £255,000 to £40,000, and in fact as low as £4,000 for some top earners. The calculation for that's a complex one, one for another day, I think, but applies to those with so-called threshold income of over 200,000 and adjusted income of over 240,000. One thing the Exchequer has spared is the ability to carry forward unused pension allowances from previous tax years. That can also get quite technical, but for some people, there's the opportunity to get full tax relief on a pension contribution of £160,000 in this tax year. By way of a quick caveat though, I hope it goes without saying that this really is something to make sure you get advice on before you start doing anything drastic. To continue the theme of tightening government purse strings, lifetime allowances have also been squeezed over recent years. There's been a bit of protection in place for some, but for the majority, there's going to be a cap at the limit of £1,073,100 before some pretty hefty taxes kick in. What that also does is limit the size of the income that you could realistically be taking from your pension. If you work on the assumption of taking an income of, say, 4% a year, the number is just shy of £43,000 a year. Now, that may be enough for you, it may not be, but either way, that's why it's so important to get planning ahead and get planning early. By the way, the allowance is frozen to 2026, so it's not going to be increasing in line with inflation as had been expected, which is what the media means when they're talking about all these stealth taxes that we're facing at the moment. So when I talk about planning early, the lifetime allowance isn't just something to be thinking about when you're approaching retirement. If you're 40 years old now and you're planning to retire at 65, if you've got a pension pot of, say, 300 grand, if we assume 5% growth per year, then that pot will have grown to £1,015,906 by the time you're looking to retire, which is obviously pretty perilously close to today's annual allowance. Not necessarily an unrealistic example there, and particularly those who are high earners could find themselves with some pretty significant challenges in the future, which is why it's just so important to get on top of this early by getting advice, getting a plan in place. A quick note too, perhaps a little niche, but worth saying that the lifetime allowance is currently only assessed against the person who owned the pension at the outset. So if you've inherited a pension, different rules are going to apply there. So given all of this sort of doom and gloom, why should I actually invest in a pension? Well, despite the constraints, a pension still represents an incredibly valuable opportunity as part of a broader and diverse financial planning strategy. It's probably also worth noting that the fact that it is such a great opportunity is why those constraints have been brought in the first place. So why should you invest into a pension? Well, one, you get tax relief on your eligible contributions. Two, you get tax efficient investment growth over time. Three, you can take 25% of the fund's tax-free cash when you get to retirement. That's up to 25% of your lifetime allowance. Four, it's inheritance tax exempt. And five, you've got some really tax efficient options there for your beneficiaries. And those latter two are picking up a really important point. As of recent legislation, pension pots are an incredibly efficient way of handing assets to the next generation. They've become a really useful tool in intergenerational and inheritance tax planning. So good to be on top of those. In particular, where pensions can come in really handy is what we call a 60% tax trap. Very conscious this is not the most user-friendly slide that's out there, so here's how it works. We all get a personal allowance every year of £12,570. That's the amount of income that we can earn each year without paying any income tax. If you earn more than £100,000 per year, that allowance starts to get reduced at a rate of £2 for every £1 over 100 grand that you make. What that means is that by the time you're earning £125,140, you've got no personal allowance left. In the meantime, as your allowance is being tapered away, for every £100 that you earn between that 100 and 125 odd grand threshold, you're only getting to take £40 home. You're getting £40 deducted in income tax, and you're losing another £20 by the tapering of the personal allowance. Now, it may be you're comfortable paying 60% tax. It's certainly some welcome philanthropy for a nation that seems increasingly to be on hard times. But if it does ruffle your feathers a bit, pension contributions can be the answer to minimising your exposure to it. So let's say you get a £1,000 pay rise, which takes your taxable income to 101,000. If you put that into your pension, that 1,000, you won't enter the 60% tax zone at all, and you'll also get the benefit of a 40% top up on your contribution thanks to all the tax relief. Equally, depending on your arrangements with your employer, you might get an extra little bonus from them too. It's also worth noting at this point that the additional rate tax bracket has come down from 150,000 to 125,140. So once you leave the 60% tax trap, you're welcomed by the prospect of a 45% rate of tax on the other side, as opposed to the 40% you'd have been paying previously. So all good stuff to be aware of. Another planning consideration that tends to cause a bit of uncertainty is the inheritance tax side of things. It's quite easy to end up with an unnecessary inheritance tax liability. A will that hasn't been done properly, a will that hasn't been done at all, lack of advice or some assumptions about your estate and some of the relief that you'll get in due course. The main problem at the moment is rising estate values. And that's particularly thanks to the boom in property prices that we've seen over the last 10 years. Couple that with the various stagnant exemptions and reliefs, and what we're finding is that increasingly many families are being exposed to what is actually a pretty punitive form of taxation. In the mid-80s, Roy Jenkins famously said that IHT, or inheritance tax, was a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue. What I think he meant by that is that there are many, many legitimate ways that you can manage your exposure to inheritance tax. All you need to do really is engage in a bit of forward planning. So with all of that in mind, we've all experienced the slightly more improvisational, shall we say, style of financial advice. The confusing, misleading messages from friends, from relatives, even from the press, or from the guy you met in the pub. We've all been there. That's why, of course, it's so important to discuss these kinds of plans with a professional, high-quality advisor. A good example of that, which we've been encountering a little bit, is some of the talk around this £1 million nil rate band. So let's try and put that into context. So currently, everyone has an available nil rate band of £325,000. Since 2007, that nil rate band has also been transferable, which means very simply, if you don't use it, you can transfer it to your surviving spouse or civil partner on your death. And then they would have a nil rate band of £650,000. There's also a primary residence allowance, which can give you an additional 175 grand as a residence nil rate band. That's also transferable, giving you an extra 350 grand potentially in residence nil rate band. So that's where the idea of the £1 million band comes from, that 650 plus the 350 of nil rate bands, residence nil rate bands. Anything over that gets taxed at 40% inheritance tax rate. Worth noting as well, as is on the slide, again, that nil rate band is frozen with everything else until 2026. Worth emphasising perhaps that I've slightly simplified the residence nil rate band situation there, and it can get quite complicated. In particular, high level, the home needs to be a primary residence. It needs to be left to direct descendants, rather old fashioned, but there we are. It's the net value that applies when it comes to thinking about mortgages and all the rest of it. And it gets tapered away for estates that are over £2 million. That's something that does tend to catch people out. So it's important to note that one as well. Given all of that complexity, the message, as you might expect, get advice, but also make sure you've got your will reviewed and up to date. That's a really important way to take one small tangible step to getting your inheritance tax position in better shape. The good news You thought there wasn't going to be any, didn't you? But the good news, in addition to the nil rate band, transfers of wealth between spouses are exempt from inheritance tax, as long as you're both UK domiciled. Certain assets as well qualify for release or are exempt from inheritance tax. And you can also reduce the value of your estate by gifting assets away. Though do be careful there, as different gifts get treated in different ways from a tax perspective. One of the most underused exemptions is gifts from income or gifts out of normal expenditure. That's a really powerful one. And the reason it's so powerful is that it doesn't have a capital limit, unlike so many other allowances and exemptions that are out there. But accordingly, as you'd expect, it comes with a whole book of rules, so it's important to get it right. Some gifts, such as a large gift to a discretionary trust, this is where we get into that point about really need to be careful about this stuff, they're treated as so-called chargeable lifetime transfers. And you can find yourself in the rather perverse situation of creating an inheritance tax liability for yourself while you're still alive. So that's really important to get figured out. Most gifts are described as potentially exempt transfers or pets. That means that the value of the gift remains in your estate for 7 years. You often hear talk of that 7 years rule, after which it remains outside the estate. During those 7 years, there's a bit of a tiering effect that means that your tax charge reduces the older that gift gets. But as I say, as with all things related to trusts and estate planning, make sure you get advice on it. Make sure you keep a clear record as well of any gifts that are made and any exemptions that you're using. That can be really, really helpful. So to summarize, these are likely to be the key considerations for you this tax year. So for the sake of time, we haven't gone into detail on all of them, but from a high level, here they are. So 1, ISAs. Are you using that £20,000 allowance in the most effective way? 2, your personal savings allowance. Have you got the right balance between your cash holdings and your longer term arrangements? 3, pensions. Are you maximising the amazing benefits that pensions can bring? 4, capital gains tax. Are you using your allowance while you can before it starts falling pretty dramatically from April? 5, dividends. Are you getting them tax-free or are you using your allowance? If you're a business owner, business director, have you thought about the right way to manage those in the future? And 6, inheritance tax. Is that something you've thought about? If so, have you got a plan for it? Make the most of some of those exemptions that are available, like the £3,000 annual gifting allowance. So that's a bit of a summary. Tax is one of life's 2 great certainties, if you take Benjamin Franklin's approach to it. So being on top of it is one of the most important aspects of a really robust, high quality financial plan. Make sure you know where you stand personally and whether you've made the most of the opportunities that are available to you ahead of crunch time on April the 5th. What we're going to do now is go to a bit of a Q&A. So for the purposes of confidentiality, we're going to wrap up the recording there. But if you're watching this back, or if you can't join us for the Q&A, thank you so much for being here. I hope you've taken something useful away from this session. If you do want to talk further about anything that we've discussed, do feel free to drop me a line at ed.evans@sjpp.co.uk, or alternatively, you know where we are, you can find us online at stringerman.com. Have a wonderful evening. But for those that remain, we'll go to a Q&A. Alison, I don't know if you'd be kind enough just to stop the recording.